Welcome to the deep dive. Our goal is pretty simple. We take some fascinating source material, dig into it, and give you the shortcut to really understanding what's going on. Today, we're jumping in the time machine going back to 1990. We're looking at the annual shareholders letter from Fairfax Financial Holdings Limited.
Yeah, and this letter, it's really something else. If you want a case study in, like, corporate honesty mixed with some big strategic plays, this is it.
Absolutely. The chairman kicked it off quoting Dickens, didn't he? 1990 was the best of times, it was the worst of times.
And he wasn't kidding. I mean, look at the numbers. They reported record net earnings, something like $21.3 million. Sounds fantastic, right?
Yeah, on the surface, a great year.
But then you dig in, like the letter forces you to, and you see basically all of that profit came from one big strategic move, a restructuring.
Well, the core business, well, it wasn't doing so hot.
Exactly. The actual operations were, frankly, losing money, bleeding it in some areas.
So that's our mission today. Unpack this paradox. How does a company pull off a brilliant strategic move that creates massive value, literally overnight for shareholders, while also dealing with some pretty serious operational and investment problems?
It's a real test, isn't it? Shows what that long-term value approach looks like when it's under pressure.
Okay, let's dive into section 1, the best of times bit, the strategic pivot. The huge event in 1990 was separating Fairfax and Markel Corporation's business interests.
Right. And you need a bit of background here. Both companies had, grown really fast from small beginnings.
They were intertwined somehow.
Yeah, they shared some business interests. But that structure, it just wasn't seen as the best way forward for the long haul. The idea was to let both Fairfax and Markel have the freedom to really chase their own growth without being tied down by the old partnership.
And what triggered it? Why 1990?
Well, the letter mentions Fairfax saw a chance to buy Commonwealth Insurance. That seems to have been the catalyst to make the move. So they did this pretty complex asset swap. Fairfax handed over its share in FM Acquisition Corporation to Markel.
Okay, and what did Fairfax get back? It wasn't just cash, right?
No, it's a package deal. And this is where it gets clever. 3 parts. First, cash U.S., $45 million. But, and this is important, $11.5 million of that was contingent.
Contingent on what?
On the financial markets recovering over the next 2.5 years. So not guaranteed money up front.
Interesting. Okay, what else?
Second, and this is really key for the shareholders, they got $1.65 million of their own Fairfax shares back. Think about that.
So they used the asset sale to basically buy back their own stock.
Exactly. And third, they got $7 million in preferred shares of a company called Lindsay & Newsom.
Let's pause on that share buyback. So 1.65 million shares. That was a significant chunk of the company, wasn't it?
Huge. It was 23% of their outstanding shares at the time. They just, poof, took them off the market. And that's just brilliant financial management, right? So Fairfax books this big $27.0 million gain on the transfer. That's where the record earnings number comes from.
But the real magic for existing shareholders
Was retiring nearly a quarter of the shares. That move alone instantly shot up their book value per share. That's the core measure of their worth, remember.
By how much?
It jumped 39%, from $12.41 to $17.29, just like that.
That's incredible. Value created without selling one more insurance policy.
Precisely.
Yeah.
Purely strategic. And they didn't just sit on the cash they got. They turned around and used it to buy Commonwealth Insurance for $57.5 million.
And was that a good deal?
Seems like it. They bought it for less than its stated book value. So the restructuring funded a smart acquisition. That's definitely the best of times.
Okay, but that success story was happening alongside some real pain, wasn't it?
Yeah.
Let's flip to section 2, the operations paradox, the worst of times.
Yeah, so we said the record $21.3 million earnings came from that FM sale gain of $27.0 million.
Which means if you take that gain away,
They actually had a net loss of $5.7 million for the year from everything else, combined their insurance and their investment banking attempts.
So the core was unprofitable. Let's talk insurance specifically. The letter mentions overall underwriting losses of $12.4 million. That sounds bad enough.
It reflected a tough insurance market cycle, for sure. But there was one part that was just catastrophic. The surety business.
Surety bonds. What happened there?
It's a textbook example of maybe growing too fast or getting into something they didn't fully grasp. The numbers are just shocking. Since starting it in '88, they'd collected about $7 million in premiums.
Okay.
But they'd suffered $21 million in gross losses.
Wait, 3 times as much going out as coming in?
Yep. And the combined ratio for that line of business,
Yeah.
330%.
330. So for every dollar they took in, they paid out $3.30.
Exactly. I mean, you can't sustain that for more than about 5 minutes. It was a total disaster. They basically had to shut down the surety writing operations.
Imagine being management, reporting record profits because of the restructuring, but knowing you have this absolute black hole in your core underwriting.
It takes guts to put that 330% number right there in the letter, doesn't it? No hiding, no spin, just here's the ugly truth.
It does build credibility, even if the news is bad.
And amidst the insurance pain, there was actually a bright spot operationally, wasn't there? Outside of insurance.
Right, the claims adjusting business, Morden and Hellwig, which now owned 100% of Lindsay and Newsome after the restructuring.
And that part was going like crazy. The letter calls it a tremendous growth record. Sales had almost quadrupled since 1986, hitting $117 million in 1990. That's serious growth.
But wasn't there a catch even with that success?
There was, yeah. Revenue quadrupled, but profits only went up by about 40%.
Why the gap?
The letter's honest about it. Their U.S. operations, part of that claims it business, were still losing money. They hadn't quite figured out how to make the U.S. side profitable yet, despite the booming top line. So even the good news had wrinkles.
Okay, let's move to Section 3. This is where the transparency gets dialed up even more. The chairman's confession and the investment lessons, particularly around their investment banking venture.
Oh, yeah. That part lost $6.4 million pre-tax. A big hit.
But the incredible part is how they talked about it.
It really is. The chairman literally wrote in the letter that these losses were mainly due to, and this is a direct quote, your chairman's bright ideas.
Wow. You just don't see that level of personal accountability often, especially not when you're writing off $5 million on one bad investment like Carbovan.
It's incredibly rare. And they didn't just admit the mistake. They drew a really profound lesson from it.
What was the takeaway?
They basically said, look, when you have really good managers trying to fix a business in a fundamentally lousy industry, it's usually the industry's bad reputation that wins out in the end. The industry's problems tend to overwhelm even smart management.
So don't bet on brilliant managers to turn around a structurally flawed business.
Pretty much. You could be the best captain in the world, but if the ship is fundamentally unseaworthy in a storm, well, you know. They realized that the high-risk world of venture capital and stock brokerage just wasn't their game. It didn't fit their conservative, long-term insurance mindset.
And they acted on that lesson, right? They didn't just talk about it.
Immediately. They got out, transferred their interest in the brokerage, Woodland Walwyn, stopped doing venture capital, became very, very wary of turnaround situations. They learned, they cut their losses, and they moved on, took their medicine.
Okay, what about their main stock portfolio? 1990 wasn't exactly a walk in the park for investors, especially value investors.
No, it was brutal. The letter calls it the worst year for value guys. Stocks that looked cheap just got cheaper, collapsing in the third quarter.
And that showed up in Fairfax's numbers.
Big time. Their unrealized losses, the paper losses on stocks they still held, just exploded. Went from about $1.1 million at the end of '89 to $34 million by the end of 1990.
$34 million, that's a huge swing. How much was that relative to the portfolio?
About 10% of their total portfolio value at the time. A significant hit to the common stock part.
And again, with the transparency theme.
Yep, they didn't hide it. They even named names. Said $7.2 million of that loss was concentrated in just 3 stocks, Magna, Woodward's, and Repap. They put it right out there.
Facing a music, it suggests they still believed in the long-term value. They just got caught in a market downdraft.
That's the sense you get. They weren't panicking. And interestingly, amidst all that pain in their core value strategy, they had one profitable trade that was completely different.
Ah, the Nikkei puts. Tell us about that.
Right. They actually made $2.4 million by betting against the Japanese stock market, using put options.
So while their value stocks were getting hammered, they made money because the Tokyo market crashed.
Exactly. The Nikkei index fell almost 39% that year. So it shows they weren't just buying cheap stocks. They're also willing to use other financial tools, maybe to hedge or just to capitalize on what they saw as a massive bubble elsewhere. They provided some welcome cash when they needed it.
That's a fascinating layer. Conservative core, but opportunistic on the fringes. Okay, final section, Section 4. Capital discipline and long-term value. Let's tie this all together. Despite the operational mess and the investment hits, what was the underlying financial philosophy?
Well, they were very upfront about their debt. They said, look, our debt situation has worsened because of acquisitions and operational needs.
They didn't sweep it under the rug.
Not at all.
Yeah.
And they didn't just acknowledge it. They set a really strict public goal for themselves They committed. No more acquisitions, none, until they got their short and long-term debt down below $10 million.
That's putting your money where your mouth is. Serious discipline. Reassuring for investors, I imagine, especially in a tough year like 1990, shows they're focused on strengthening the balance sheet. Need that dry powder.
Exactly. And this is where you get the real aha moment, especially for you, the listener, trying to understand their approach. Because despite all the bad news in 1990, the surety disaster, the investment banking losses, the $34 million paper loss on stocks, you look at the 5-year track record from 1985 to the end of 1990, and the compounding story is just incredible.
Give us the numbers. What did they achieve over those 5 years?
Get this. Book value per share went from $2.08 to $17.29.
Wow. What's that as a growth rate?
It's a compounded annual growth rate of 53%. 53.
Per year. For 5 years, that's astronomical.
It really is. And their average return on equity over that period was 24%, putting them in like the top 5% of major Canadian companies. Phenomenal performance.
So that underlying value creation was just immense, even with the terrible 1990 mixed in.
Absolutely. But here's the kicker, the final piece of the paradox.
What's that?
The stock market wasn't rewarding them for it. The letter points out their share price had only compounded at 30% annually over that same period.
Still good, but way less than the 53% book value growth.
Right, which meant that at the end of 1990, their shares were trading at a 36% discount to their book value. Back in 1985, they traded at a 50% premium.
So the market sentiment had completely flipped. The company was fundamentally stronger, growing value like crazy, but investors were pessimistic and marking the shares down. That's a classic value investing scenario, isn't it?
It really is. It's the ultimate test. Do you trust the underlying value growth or the market's current mood? And Fairfax, despite knowing things would likely still be tough in the short term, stuck to their guns. Their goal remained compounding book value at over 20% long term. High ambition even then.
Okay, let's wrap this up. If you distill it down, what are the big takeaways from Fairfax's wild ride in 1990? I see maybe 3 main lessons.
Go for it.
First, the sheer power of smart financial strategy. That restructuring and share buyback created enormous instant value, totally separate from the day-to-day business.
Absolutely crucial. Lesson 1. Strategic capital allocation is key.
Second, the absolute necessity of radical transparency. Owning the mistakes, like the 330% combined ratio or the chairman's bright ideas, it builds long-term trust, even when the news is bad.
Couldn't agree more. Lesson 2. Honesty is the best policy, especially when it hurts.
And third, the resilience needed to stick to your knitting during market turmoil. Facing down that $34 million unrealized loss without panic selling because you have the financial strength and the long-term view.
Yep. Lesson 3. Endure the short-term pain for the long-term gain. Stay disciplined.
So, a final thought for our listeners. The chairman ends the letter with that classic line, "No trees grow to the sky." He admits that 53% growth rate can't last forever.
Right. Total humility there.
But then, in the same breath, they reaffirm this very ambitious goal of compounding at 20% plus long term.
Yeah. So here's the question to chew on. How should you, as an investor, think about a company that's both incredibly humble about past, maybe unsustainable success, but also fiercely ambitious about the future? What does that blend of realism and high aspiration tell us about finding companies that can genuinely compound wealth over the really long haul? Maybe it's that balance that's the secret sauce.